Good afternoon to our valued shareholders, clients, and stakeholders. Thank you so much for tuning into the Barita Beat, the pulse of our performance. I'm Kerry Bayliss, Vice President for Strategic Business Development and Investor Relations here at Barita, and also the host for today's investor briefing. On behalf of Barita, I'm pleased to welcome you to our earnings call. We have a lot of updates to share about our second quarter financial earnings, which ended on March 31st. And joining me today are members of our senior management team who stewarded us through a challenging first quarter into a successful second quarter. So allow me to introduce our newly appointed CEO, Ramon Small Ferguson, who is also the Managing Director of Barita Unit Trust Management Company Limited, Dane Broadbow, CEO Designate for the Financial Holding Company and Acting CEO of Cornerstone Trust and Merchant Bank, and Stephen Philibert, our Chief Financial Officer. The format of this session will start with an overview of the Q2 financial results and will then be followed by a review of the market and an overview, followed by some important updates on our outlook, our strategy, and our overall corporate governance. We look forward to a very engaging session with you. We want to hear from you, we want to hear your feedback, your queries. So at the end of the presentation, we will have a Q&A section. So please keep an eye out for the Q&A box on your screen. And as we go through the presentation, if you do have any questions that come up, please feel free to drop them in that Q&A box. And we'll do our best to answer as many questions as we can at the end of the presentation. So I'll close off here and I'll hand over to Stephen so we can formally begin.
Thank you very much, Kerry. Ladies and gentlemen, good afternoon. It's my pleasure to take you through our financial highlights for the second quarter of our 2024 financial year. And we'll start with the operating income. Net operating income for the 6 months decreased by 555 million, or about 10%, to 5 billion, relative to 5.5 in the prior year. Primary reason for that is lower gains this year relative to prior year on investment activities. In both years, the gains were very good, but not quite the pace that we were at last year. Net interest income had a decrease of about $74 million to 286 billion from 360. We've spoken in previous briefings about the impact of changes in the interest rate environment on this line item, and it's something that has been seen across the entire industry. We do think that we're close to an inflection point on this item. Fees and commissions income is up year on year to just over $2 billion from just under 1.8 billion. It's about 13%, and that's driven by better results from our investment banking line. And finally, gain on investments, the figure there is 2.56 billion relative to 3.26 for the reason mentioned previously. Moving on to operating expenses, we're seeing 2.326 million relative to 2.18 in the prior year. That's an increase of just under 7%. So actually better than inflation. It's comprised of just a 4% increase in staff costs, so it's significantly better than inflation there, and admin costs being up 9%. So we think overall this is reflective of good expense management. In the increase that you're seeing for the admin side, a lot of it is actually related to asset tax, which is simply reflective of the growth of our balance sheet. These two items are offset by a write back of ECL provisioning, which was 20% higher in the current year, write back of 154 million relative to 128 in the previous year. In the previous year, it related to significant loans that had come off of the books, and therefore the provisioning for those loans could likewise come off. In the current year, it relates to updates to the inputs to our model, which is required from time to time. Those updates may lead to a swing either way. In this case, it was a swing towards reducing the provisions. And then financial position. So some key highlights of the balance sheet here, and then a word on the profitability and per share. Total assets, I'd made reference to the growth in our balance sheet, which again drove that increase in the asset tax that reflected in in the admin costs. So here you're seeing the total assets up to 134 billion relative to 128, or about 5%. The investments securities portfolio, which is comprised of our pledged assets line item and the marketable securities line, up to just under 106 from about 104.7 in the prior year. So there's not significant growth there. On the loan side, by percentage, certainly more growth there, 8% growth up to 11.8 from 10.9. On the funding side, liabilities is up 6% to 98.7 from 92.8. It's driven predominantly by the growth in the repurchase agreement liability line. That's up to 84.2 from 75.4 rounded, or about 12%. This is partly offset by reductions in secured investment notes of about 82%. So that line item has come down significantly. And then we had a small reduction, 5% reduction in other debt facilities to 7.8 billion from 8.2. Shareholders' equity up marginally, 1% to 35.6 relative to just under 35.4. Overall, net profit for the 6 months at 1.9 billion relative to just under 2.6 in the prior year. And again, we'd spoken on the income page about what mainly is driving that year-over-year change. So that's 26% down, and is reflected also in earnings per share figure to $1.59 from $2.16, which is equivalently 26% down. Our capital adequacy continues to be very strong, 26.1% relative to industry average of 19.6%. And as a reminder, the FSC minimum requirement is 10%, so we're significantly ahead of that. Just a brief recap of the financial highlights. So net operating revenue, 5 billion, net profit, 1.9 billion, shareholders' equity, 35.6. Total assets has grown to 134 billion. Efficiency ratio has improved somewhat to 47%. And then you see also there are ROE and leverage figures. ROE just above 10% at 10.7 and leverage at 3.7. And with that, I'll hand over to Ramon Small-Ferguson, our CEO.
Thank you very much, Stephen. So I have the pleasure of talking to you about the market and how that has underlined our performance as a company for the quarter ended March 31st, 2024. So just to talk a bit about a couple of macroeconomic variables, and again, looking as we have in past briefings at the local versus global picture. And I'm going to start off with economic growth. Right? Locally, economic growth has remained robust, and there continues to be favorable near-term expectations, albeit with that growth potentially decelerating a bit. Right? And the factors underlining the economic backdrop or the performance that we have seen in the most recent previous quarters are the continuation of the programmatic deleveraging of Jamaica. Right? Public debt has continued to decline rapidly, and that is entrenched. Right? Fiscal prudence continues to be the order of the day. That's underlined by a sound policy framework, and generally speaking, both from the perspective of Jamaica's international credit view and from how the government's reduced appetite for debt has released capital into the market, both those factors have helped to improve growth prospects here in Jamaica. Globally, from a growth perspective, the IMF has revised the growth outlook for the world higher, citing trends in the United States as being the primary driver, which would have offset a modest downward revision across several other economies. Right? Growth in unemployment and incomes have been supportive of the growth picture overall, despite the impact that would have had on trying to contain inflation. And demand has remained resilient, and what it has allowed for is an easing almost of fiscal support, right, which would have played a predominant role in the pandemic and post-pandemic period. Right? When you look at inflation, locally we have seen a significant retreat in inflation levels. You'll recall that inflation peaked out at just under 12% in April of 2022, and we have now seen deflation calendar year to date of 1.8%. The last headline rate rather reported up to August of this year was 5.3% on a point-to-point basis. Right? On the back of this, we would have seen the BOJ's most recent MPC decision from a rate perspective being to hold rates at 7% amid them looking at the risks associated with inflation in the near term. Right? From a global perspective, we have also seen inflation declining, actually at a faster than expected pace. The supply chain issues which plagued us during the pandemic are seemingly working themselves out, with notable regard to what's happening with energy prices, right? And we think that the decline in inflation is also driven by reduced tightness in the labor market. That has been a key factor, right? And, as I've said in previous meetings, while the factors that are driving inflation across different countries are idiosyncratic, what we are continuing to see is some synchrony in the direction of inflation. So most countries saw inflation rise for different reasons, and now we're seeing a retreat in inflation across most countries, again for different reasons. So let's talk about the vectors of our performance. So Stephen spoke to the year-to-date period where, in fact, we have had a contrasting set of performances in Q1 relative to Q2, right? If we look at our key measures from a P&L perspective, revenue and say profits, we would have had an almost tripling of our revenue metric, 3.6 billion or so relative to about 1.4 billion in Q1, so about 2.5 times. And we had a tripling in profits, 1.43 billion in Q2 relative to about 470 million in Q1, right? And that contrast in performance, Q versus Q, has really been driven by some of the factors that we would have described in previous quarters bearing out, right? And I'll explain. There are a few initiatives that we've been pursuing, and some of them have taken hold during this quarter. One is a continued focus on revenue diversification, right? We have been steadily focused on implementing initiatives to really shift away from revenue concentration. And during the last quarter, we would have seen a bit of a resurgence of revenues from what I describe as traditional sources. So revenues from the category that can be broadly referred to as treasury trading and brokerage would have constituted almost 40% of our overall revenue base, with revenues generated from securities trading, from our on-book equity and fixed income exposures, from equity brokerage, from FX trading to our Cambio, all of those revenues combining to show a material uplift year over year, right? And that is very positive. Investment banking also had a fantastic quarter in Q2. We would have generated over $300 million in revenue from that specific revenue category relative to about $29 million in the comparable quarter in the previous year, right? So again, a significant contributor to that resurgence. And again, underlined by the deliberate strategies to focus on revenue diversification, right? We have also focused on setting the business up to be nimble, right? To position ourselves to be able to execute on what we describe as market neutral investment strategies. And what that means is that we want to be in a position to win regardless of the directionality of the market. What really sets us up to do that is our strength of capital, which Stephen spoke to, and our focus on maintaining low leverage and high liquidity. And that has worked very well in the most recent quarter, again, with the return of significant revenues from fixed income and equity trading. The final point that I'd highlight, which is to the left of your screen, is our continued and still focus on efficiency. Right? Cost management has become increasingly critical given the challenging market environment, and we have figured out how to do more with less or more with the same. Right? And as we look at our overall strategic transformation of the group, which Dean will speak to in more detail when he gets to his section of the presentation, we're also seeing how we can operate more efficiently as we transition to a financial holding company kind of structure, right? So during the last quarter, in line with our prior guidance, we continue to see revenues from our real estate exposures moderate, right, which is understandable given that we're now moving to a phase where we're going to be seeing revenues come more from developments vis-a-vis valuations on the real estate side, right? Additionally, during the last quarter, we would have seen more conservative marks being applied to some of our private equity exposures, which would have offset some of the revenues generated from that category as well, right? Now, our outlook with respect to the revenue picture largely turns on what happens from a monetary policy perspective and what happens from an investor sentiment perspective, given the nature of our business, right? We remain very constructive, right, about how things will evolve with respect to interest rates over the next several quarters. And we think that there remains several untapped opportunities in trading and investment banking, right? We're seeing the capital markets heat up a bit. Things are getting exciting again, right? When we think about the tactical approach of both the US Central Bank, which is really from a global perspective, your first port of call, and we look at what's happening on the local front, both central banks appear to be leaning towards a position of either interest rate stability or lower rates, right? We think our business is well set up to thrive in either environment, given that we are experiencing repricing of our assets now that they are maturing and running off, and we are experiencing repricing of our liabilities, but they're actually repricing a bit lower, given that rates have been generally stable, right? So in terms of our tactical imperatives in the near term over the next few quarters, they remain the same. We're going to continue to focus on that diversification. We are going to be executing on market neutral investment strategies. So wherever the wind is likely to blow, we will seek to position ourselves to benefit. And finally, we will continue to focus very heavily on cost efficiency throughout the Barita Group. So I'm going to end my section of the presentation by reminding around some of our business lines and kind of talking about, again, just reiterating specifically what has happened in those lines, right? So from an investment banking perspective, year to date, we have seen a resurgence of revenues from this line. Right? Year to date, the investment banking business has contributed over $650 million in revenue to our total revenue stack, right? And again, capital market transactions have started to pick up, given the interest rate stability that we have seen over the last several quarters. Money market activities and securities brokerage have also started to pick up a bit with respect to our spread business, net interest income. During the last quarter, we would have seen some stabilization of revenues from that line, with, as Stephen said, prospects seemingly for some improvement in the net interest income line. And then on the trading front, we would have seen a significant uplift in revenues from that line, given the state of rates during that period. In terms of our fund management business, asset management specifically, we saw a 1% rise in total AUM year over year to $360 billion, and our pure play asset management business would have seen an uplift of about 10% in revenues for Q2 specifically, evidencing growth there despite the challenging operating environment. The alternative investment side of the business, again, the exposures there are largely to real estate, private credit, and private equity. During the last quarter and year to date, we have seen continued returns from our real estate exposures. And again, those positive returns would have been offset by some adjustments down to values of certain private equity exposures that we would have had. Finally, with respect to Cambio trading, we continue to be a prominent player in that market. And year to date, we have seen an uplift in revenues from the Cambio trading division as we have traded more volume year to date and managed to maintain our spreads. With that, I'll hand over to Dean, who will talk to us a bit about the present and the future in the group.
All right. Thanks, Roman, and congratulations on your new appointment. And congratulations on a record quarter. Definitely a fantastic start out the gate. So, as we mentioned in previous meetings, the strength of our capital has really enabled us to remain resolute in execution of our strategy during challenging times. This would have been most aptly demonstrated during the rising and elevated interest rate environment over the past several quarters. Now, robust capital is an emphasis throughout the group. Barita is the largest securities dealer by shareholders' equity and has capital ratios well above the industry average. Similarly, its sister company, Cornerstone Trust and Merchant Bank, has the highest capital adequacy ratio among deposit-taking institutions. Now, those ratios not only mean resilience, but also mean growth capacity. We expect this year to be transformational for the group, with reorganization being an important step in that process. And our capital will remain the foundation that the growth of our group is built on. So again, the strength of our capital is important because it gives us the capacity for growth, both organically and inorganically, allows us, as we have demonstrated over several quarters, to comfortably withstand shocks. And again, given the less liquid nature of the alternative investments, it provides a stable funding base to support that strategy. So similarly, we have spoken previously about the vast investments we've made in our governance framework, or risk, governance, and internal controls. And, similar to what I mentioned about capital, all the policies and procedures, all the risk frameworks, all the elements of our control environment and the talent to support it, really, it's an investment both in Barita, and also throughout the rest of the group. Similarly, again, we'd have spoken about several investments that we'd have made in technology over the years in Barita. And again, really technology really serves as the epicenter of how we expect our group to evolve, right? So we've talked about these investments in technology at Barita, but elsewhere in the group, the investments in technology really are probably even more substantial. So again, that's going to be a key element of how our group evolves. So we have spoken in prior meetings about our impending reorganization. And just to recap again, what will happen is that Barita Investments and Cornerstone Trust and Merchant Bank will be subsidiaries of a single financial holding company. Right? So we're currently going through the process, pretty advanced in the process, and we expect that by the next investor briefing that we would have concluded our reorganization. Now, so we're going through that corporate reorganization, and we're also using the opportunity to ensure that we're organized internally to take advantage of that as well. And as we organize, we do it around two main ideals: customer centricity and efficiency. Customer centricity in terms of ensuring that our customers across the group have access to the full scope of our capabilities in a manner that's as seamless as possible. And for efficiency, ensuring that we, through the unification of standards, to the sharing of best practices, ensure that these services are delivered to our customers in as streamlined and as efficient a way as possible. Right? So as we think about how the group has evolved through the various acquisitions, generally speaking, what we've seen an injection of capital to really strengthen the base of the group. We've seen solidifying governance. We've seen investments in technology, and very importantly, investments in human resources, both in terms of curating the necessary talent for the team, and a fantastic set of individuals, and also ensuring that internally we're set up to develop that talent as much as possible, right? Now, following that, we're now reorganizing, as I mentioned, with the ideals of customer centricity and efficiency. And having already seen that culminated in Barita, we expect to shortly see that culminating to the rest of our group. Again, thank you, and we're ready to answer your questions.
Great. So thank you, gentlemen, for sharing those updates and important insights. We now move into the question segments. I've seen quite a few coming in throughout the presentation. So just a reminder that this is an engaging session. It's not just an opportunity for us to share with you, but also for you to share with us and allow us to answer your questions. So if you haven't already and you do have questions, just go ahead and drop them in the Q&A section on the screen, and we'll jump in and start answering some of those questions. All right, so our first question. Net interest income seems to be stabilizing or improving. Is this the outcome of deliberate management action? If so, what are those strategies, and are they likely to continue to work in light of both the Bank of Jamaica and U.S. Federal Reserve's posture of keeping rates elevated over the near to medium term?
It's a good question, right? And I kind of alluded to it in my presentation, but I'll probably be a bit more specific. So from our perspective, right, based on how our business is set up in terms of funding versus assets, what we do have is an asset portfolio, specifically our fixed income or interest-bearing portfolio, that has a longer maturity date typically than our liabilities, right? So over the last couple of years, what we have seen is a very rapid increase, relatively speaking, in interest rates, both here locally and internationally, right? And it has meant that our liabilities have repriced very quickly, almost instantly, it would feel like. And our assets have taken their sweet time to mature and reprice, right? Now, what that has caused in terms of its effects on our profit and loss statements is that we have lost substantial revenue that would typically come from net interest income. In financial year 2022, for example, we would have registered for the full year about $1.6 billion in net interest income. In financial year 23, I think we registered less than $600 million in net interest income, right? So in that context, you would see that year over year, the effects of this, we would have lost about $1 billion in revenue, right? Now, what has happened in the last couple of quarters, I'd say, is that we have started to see a slowing in upward repricing of our liabilities, right? And in fact, we have, from a management perspective, been very deliberate now about managing the increasing cost of those liabilities, given that the interest rate environment, despite it being higher than 2 years ago, is certainly now much more stable than it would have been, say, a few quarters ago, right? On the asset side, we're having assets mature, assets that were yielding much lower levels than are now available in the current market environment. And we now have an opportunity to reinvest those maturity proceeds into higher yielding assets. And we think the combination of those two things, even if rates remain just where they are, right? They don't need to go down. They remain just where they are. We believe the combination of those two things continuing over the next several quarters could see a reversal in the trend that we have seen in net interest income. And we can move away now from stabilizing and actually see that revenue line start going up. So fingers crossed. Well, we're certainly managing in that direction.
Thanks, Ramon. Our next question is asking if Barita will pay another dividend later this year.
So I'll probably take that one. Right. So we would have paid a dividend in February of this year. I think it was declared in January, paid in February of about $2 billion. It is typical for us as an institution, we've kind of set a precedent of being constructive with respect to dividend payments, right? And the framework that we follow is risk-based. We look at what's happening in the market environment first and foremost and assess the state of uncertainty. Then we look at what's happening in the company to ensure that the key risk metrics are robust, capital, liquidity, and so on. We do stress tests to see how changes in the market environment, particularly drastic changes, could impact the business as is and post any potential dividend that we're contemplating. And only then would management feel comfortable having assessed all these metrics and them remaining within tolerance. Only then would management feel comfortable making a recommendation around dividend payments. Right? So we have a couple of quarters to go to the end of the year. Right? The earnings picture of the business is positive. So we are certainly constructive around considering making recommendations with respect to dividend payments. But of course, it has to fit within the frame that I just mentioned. So we will, at the appointed time, make more definitive statements with respect to dividends. But just giving the frame for people to understand, what the key determining factors and drivers are.
Understood. Thank you. So one of our viewers is asking, what do you see on the horizon for the Jamaica Stock Exchange? They're being patient, but they're also curious at the same time what the outlook is for the market.
Probably me again. So unfortunately, I didn't bring the crystal ball to this meeting, right? I'm going to have to rely on a bit more science. But what I would say is that we did see a positive performance on the JSE for the calendar Q1 of this year to March, which is pretty good. And what we're detecting in our shop are two things. One is the fundamentals with respect to many companies listed on the JSE are increasingly positive, right? So there are bright spots on the market from a fundamental perspective. The other thing is that from an investor sentiment perspective, we're seeing where despite sentiment remaining certainly lower than the heights of, say, a 2019 pre-pandemic, sentiment seems to be improving, right? In terms of capital market activity, we have seen companies now come to the equity market to raise money. We have our first IPO, and it's May last year. I think first IPO came in August. And that's out there in the market. There is a really large additional public offering out in the market, NCB. Again, indicating that from an investor sentiment perspective, there appears to be appetite to look at opportunities, right? So with respect to the JSE, our own perspective is that there remain bright spots. There is an opportunity in the present day to get constructive and actually start potentially building positions in some of these stocks that are trading well below their highs in solid companies. Remember, equity investing is a medium to long-term endeavor, right? And it requires a few years sometimes to germinate and really show and unlock true value. So we think during this period where the market has taken a bit of a beating in the last couple of years, companies, however, are showing their salt, showing their worth, remaining fundamentally strong. We think it's a good time to get constructive and start legging in.
Thank you. So while we're on the topic of the stock exchange, there are two more questions in relation to same. The first one is, given the recent performance of the Capital Growth Fund over the last 2 years, what changes, if any, will Barita make in order to start having the fund trending upwards?
Questions all seem to be for me today. None for Dane and Stephen. So the Capital Growth Fund, as I have said, I think in previous iterations of this meeting, really reflects largely, but certainly directionally, the performance of the JSE, right? It is heavily exposed to local stocks. That's the nature of the strategy. And given that the JSE itself has had challenges over the last couple of years, the fund certainly has not been registering fantastic performances in that context, right? So with respect to how we are positioned, I'll speak generally, because I don't want to give away all the details of the strategy. The asset management team would certainly seek to do me harm. But what we have been doing during this period is exactly what I just mentioned a while ago, that we think generally investors who look at this segment of the market should be doing. We have been very constructive. We've been looking for areas of value in the market and being very strategic around taking positions. We have taken the opportunities as they have presented to maybe reduce our exposure to certain positions that have maybe done very well. And we now have a concentrated position or positions where, we think that there may be better prospects elsewhere. So we've been doing some swaps to other securities. And we remain very confident about that strategy, just as we remain confident about the market in general. We think over the course of the next several years, as Jamaica recovers, we believe that there will be that will bear itself out in the equity market, and by extension, our capital growth fund strategy as well.
Thank you, Ramon. Have another follow-up question there. So you did mention about NCB's APO, and we are being asked, what are our thoughts on the NCB APO?
Well, that's a convenient question. So I'll speak to our institutional position and then give some more information. So our institutional position is to participate in the APO. I believe we have a buy recommendation with a $81 plus price target on the APO. And I say it's a convenient question because almost immediately following this briefing at 4 p.m. today, we do have an investor briefing focused on the NCBFG APO. We are selling agents for the APO, and we will be hosting some of the senior leadership team from NCB in a forum to discuss the APO. So if you want more information about the APO, you can join us at 4. The link is on our website, and you'll be able to interact with the senior leadership team of NCBFG to quiz them about what they intend to do with all of this money and how they intend to create value for shareholders. So almost immediately following this at 4, you'll have that opportunity.
Thank you, Ramon. So it looks like we are going to be holding most of you for the entire afternoon because we have a lot to share today. All right, our next question is really asking if you can say more about the potential synergies of the group structure and the timeline for the realization of these synergies.
Okay, thanks. Kerry, I'll give Ramon a break and take this one.
Thank you.
In the hot seat as the new CEO. So, I mean, as I'd mentioned in my presentation, the primary ideals surrounding the reorganization really are customer centricity and efficiency. What the reorganization also allows us to do is really better streamline our risk management, right? Now, see, you can think about it as, from an external standpoint, customers, again, having access to the full capabilities of the financial services that our group can offer. And as we evolve, and as we reorganize, we're reorganizing from the standpoint of the customer. We're reorganizing with the customer in mind. And a lot of what we're looking to do is to really get deep in terms of our customer centricity, real, well beyond surface level customer centricity. We expect from an outward perspective for our customers to see that as our group evolves. Internally, it's really about ensuring efficiency. Ramon spoke a lot about our cost management, and really what we're looking to do is leverage the technology, leverage the various procedures, leverage the various best practices to really ensure that as much as possible, from a group perspective, we're able to have the supporting processes and have the supporting infrastructure that allows us to, materially reduce the cost of delivering that service to our customers, right? So, I mean, technology is a large part of those synergies that we'll see. The technology will move, in different speeds, but overall, it culminates into what really is a digital-first posture for the overall group. So, in terms of timelines, we expect that by the time of the reorganization, we'll start to see the definitely starting to see the impact of that group structure and that reorganization. And over time, it's going to evolve, right? Because our technology and our capabilities, where that is concerned, are going to evolve. The procedures surrounding a lot of what we do are going to evolve. So you'll start to see the impact of that at a point in time when our reorganization is complete. And over time, we expect those benefits to evolve as a lot of elements of what we're doing evolve as well.
Thank you for that, Dane. So we have a two-part question here from one of our viewers, which is asking about Barita's plans for expansion and if there are any plans for future acquisitions. They've also asked or made mention to the fact that in our annual report, mention was made about the launch of new revenue streams and asking if these have yet been built out and how will they add to the current outturns.
All right, so I'll take that one. All right, so with respect to, I'll probably start with the second question first. With respect to new revenue streams, yes, I can tell you what we're contemplating and what the work that we have done thus far. Right? And the new revenue streams largely travel along the roads that we're already familiar with. So on the asset management side, we're looking at potentially expanding our product line to appeal to a broader cross-section of investors, retail and institutional. Right? We want to be able to create portfolios that give exposures that are different from what are presently available, certainly in our shop and potentially in the market, to allow for further diversification and allow for persons to really experience value creation in a different way. Right? And we are on the cusp, I'd say, of making some public headway with respect to product development there. With respect to other areas of our business, investment banking, for example, it's our intention to push deeper into other markets within the region, not from a boots on the ground perspective, but we do think that Jamaica's sophistication with respect to capital markets uniquely positions us to be a conduit to the region in general, to be a place where funding stacks can be curated ahead of being distributed even external to Jamaica, right? We think we have strong investment banking minds here, and Barita wants to play a significant role in all the funding that needs to happen in the region. So we already have deals that we have done outside of Jamaica, but we want to expand that, which again will be another source of revenues for us. We do see opportunities as well to really expand our market share in certain customer segments. So we do see ourselves as the people's broker, and we want to expand our capabilities to scale up on the retail front. Dean rather spoke to the opportunities that technology bring to our doorsteps as businesses, and that will help with scale. We do want to serve our institutional clients more completely. So getting more of our products in the hands of the corporates that we serve is important to us. And we do want to expand our capabilities on the private wealth front as well. And that's another segment where we want to grow market share. So we're traveling along the same roads, but we are seeking to do more and do things differently to really appeal to a broader cross-section of persons and really grow our heft in these different segments. With respect to inorganic expansion, generally speaking, as a company, we're always looking for opportunities that may complement our group. But for now, we see our business as being very capable with respect to executing as a full-service investment bank and asset management firm. So to the extent that an opportunity presents, we will diligence it and see whether it fits and whether it's worthy of us pursuing from an acquisition perspective. But for now, we're doing, we think, as much as is possible with the capabilities that we have built out organically.
Thank you, Ramon. So we have another question asking, how often are meetings like these being held? Which I guess I can take that one. And I hope that means that we're finding the information very useful. So the Barita Beat, the pulse of our performance, is our quarterly earnings call. So you can expect to see and hear from us every quarter shortly after our financials have been published. So please keep an eye out for your emails, our social media, our website, where we'll be sharing at the end of each quarter the release date that we'll be hosting our earnings calls. All right, so as usual, we do have a number of questions in relation to the real estate fund. So I'm going to see if we can maybe have one comprehensive update in relation to that area. So we have somebody asking how the real estate fund works and also what are the future plans for development of the real estate portfolio.
All right, no problem. So I can speak to that. So our real estate portfolio is a unit trust fund, which means that investors can both purchase and redeem units according to the rules surrounding that, right? There is an initial mandatory hold period given the nature of the assets that compose that fund, being real estate assets, right? And the fact that those assets are not as liquid as, say, money market securities. But what the fund does is allow for investors of a smaller scale to gain diversified exposure to a portfolio of real estate assets. Right? Now, over the past couple of years, we have added significantly to that portfolio. And the portfolio overarchingly is now comprised largely of properties that are well poised for development or essentially repurposing. Right? Now, as we have telegraphed over the last couple of quarters, we are now in the throes of dealing with the development side of things. Right? So, we're putting together our development schedule, and we have actually earmarked our first development, in that fund, right? In terms of the first development that will be done, and we're down the wicket with respect to planning, etc., in relation to that. So what we expect to see over the course of the next few cycles is the serial development of the assets, the opportunistic development of the assets within that portfolio, which we expect to be the primary source of value creation from the portfolio going forward. I mean, we see kind of three main sources, right? One is the development element of things. Two relates to, what's happening in the property market around these properties. And three, which is where we have seen a good bit of value created thus far, is how we've structured the purchases and where we've actually been able to acquire these properties from a price perspective. Right? So a good bit of that value has been had already. We expect market conditions to continue to be supportive of the, maybe modest improvement in prices in relation to the portfolio. But certainly where we expect to see a lot of the value is through bringing these properties to highest and best use via development or repurposing. So that's the update with respect to the real estate.
Thank you, Ramon. All right, so I think based on that, we have completed answering all of the questions that have been submitted. So thanks again for raising your questions with us and allowing us the opportunity to answer them. So I think at this time, it brings us to the end of our Q2 earnings call. So ladies and gentlemen, we just like to thank you again for engaging with us. It's really important for us that we get to connect with you and address your questions and be able to share these valuable insights with what's happening within Barita each quarter. So I'd like to take the opportunity to wish you a very wonderful afternoon. We really look forward to seeing you again at our next staging of the Barita Beat, the pulse of our performance. Have a great day, everyone. Thank you.